Hey, this is Paul Winkler. Thanks for listening to the show. Don't forget to subscribe on Apple, Google, or wherever you get your podcasts. If you're not sure how, go to paulwinkler.com/how-to-subscribe. All one word, how to subscribe, or click on the link in the show note.
Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, back here on the Investor Coaching Show, Paul Winkler talking about money investing. Yep. That's what we talk about. There's lots of stuff. Oh my goodness. So much stuff to talk about today. And it's just me, myself, and I. But don't worry, folks. I am a trained broadcaster. I can handle this. After 20-something years, I ought to be able to handle this by myself. You know, I just have the other guys here sometimes just for eye candy, right? Come on, Leviticus. You know how that goes. This segment's for you, my friend. Yeah, because I am. You know how I like to wax philosophical, and I know how you like when I wax. So I'm going to do that, and I'm going to do that in a kind of an unusual way. It's been one of those weeks where I think it's required, but I think that there's an educational aspect of some things that have gone on this week that are going to be helpful from an investing standpoint. So I'm going to launch into some things. All right. So, it's been a big week from a news standpoint. I mean, all the way from, good grief, there's stuff about Robinhood. There was something about that. There was some good stuff about hidden costs of free investment services, something that has been a big topic of mine. There have been just really, really interesting data that I found on that. And then also, the other thing, the big news of the week, of course, has been this trial. Good grief, who can not talk about the trial that, with the verdict coming down and everybody's talking, Kyle Rittenhouse and, what happened there and what does that have to do with investing? You're going to be amazed what this has to do with investing, actually. Yeah, it has a lot to do with psychology is really what it gets down to. And that's kind of the direction I want to go with this because this reminded me so much years and years ago. Okay, so I used to teach this workshop years and years ago, and oh man, I'm trying to remember. There were so many different titles I've had for workshops over the years. But I had this workshop that I would teach, and I would go through how investors choose investments and the mistakes that they make around their investments. And you look at the Dalbar research, and I've talked about this many times. You look at the Dalbar research, and you look at the average investor in the stock market versus what the stock market did. Now, they've been doing this data since like 35 years. I mean, the first data that I saw was 15 years, I think it was, as I recall. And you found that brokers were getting just as bad a returns as the investors were getting. And then you found that, if you looked at asset allocation funds, I mean, literally the rate of return was about what the inflation rate was. Asset allocation meaning that they're investing between stocks, bonds, and cash, making decisions on your behalf. And the investment world, they're really good at hiding really bad results because what they do is what's called survivorship bias. They'll close down things that haven't done well. And the other thing they do, they don't do what's called GIPS auditing of the investment portfolios. And what that stands for is Global Investment Performance Standards. And it's something that I think is you ought to do that. I mean, if you're investing in some investment vehicle or some mutual fund company, I don't care if it's a huge mutual fund company, you ought to know what the results have been of their investors. I mean, what are you investing for? And you have no clue what they're doing and how they're doing. And, you're just going investing, and it's the ultimate in blind faith. And people think, well, it's a big company. How would they be big if they weren't getting good results for their investors? The reality of it is Most people don't realize they don't even know how to calculate how their returns have gone. They don't have a clue how they've done. And they're just investing on emotion. They're not thinking through really what they're doing. It's a really, really big company. So what they do is they just blindly go, well, it's a really big company. And it's a leap of faith when they do that. And typically what they'll do is they'll look around and go, well, what do I look at when I invest? And they look at past performance, and they invest based on, past performance. They buy funds after they've done well, or they're investing based on, this thing has a lower expense ratio than this one does over here. So they're investing based, it's all emotion. So I used to talk about this thing, and I would talk, and I had in the workshop, I had a picture of a filter. And it was kind of like a filter that you would use to put, gas in your tank or something like that, okay? So in the top of the filter, what I would have going in would be facts, data, statistics, information that you might look up and things that you might look up when you're trying to decide what to invest in. And I was talking about how people make decisions. They gather data, but they filter it. And they filter it through their emotional filters. So if I am scared, I am going to discount a lot of things that somebody else may actually pay attention to. If I'm greedy, and I'll get back to that in a second. But I filter it, and then I make a decision. An example I used in the workshop was Bill Clinton. And I said, back, and this was, actually I was teaching this workshop. This shows you how far back this goes. I was teaching this workshop when this was news. Bill Clinton, Monica Lewinsky, right? That whole thing was in the news, and you couldn't get away from the TV hearing about it. And you see these people come in with reams of paper, absolute stacks of paper of evidence. And before the whole trial, before anything came out, before any of the evidence hit, you were getting this information, you were watching TV, and you were for him. You were on his side, and you were hoping, that you're going, no, I think he's great. I think he's innocent. I think it's, nothing going on. And then you had on the other side these people, no, he's guilty as sin, and, he's terrible, blah, blah, blah. And all of a sudden, all this information comes in, and at the end of it, what happens is you have the same people that were saying, no, he's great, he's fine, there's no problem, everything's great. They were on the same side. They didn't change sides. And the people who were against what he was doing or against him were still on their side. And it was just this emotional filter that people had run things through. And that's exactly what people do with investing, and more about that in a second. But so I'm having this conversation with my sister Deb, down in Florida, and I said, "This is how people do things." And she goes, "Well, wow, don't facts matter?" And I says, "No, actually they don't." And I said, that is the challenging thing about psychology. A lot of times facts do not matter because we hear things and we run them through an emotional filter. And what happens is we will overlook things that don't line up with what we want to believe. We'll just overlook them because it doesn't fit what we want to actually see or what we want to believe is true. I mean, it's just the way it is. And what we do is we want simple answers because we want to put things in tidy little boxes. Because, the reality of it is we think we are so sophisticated as humans. We really do. We give ourselves way too much credit, thinking that we are incredibly sophisticated. And the reality is, remember we said that, that what was going to happen is in the information age, we would have all of this great information. We'd be able to make better decisions. And the reality is, no, the more information we've gotten, the more confused we get. And, it gets even worse as you age. As I've talked about before, as you age, you think you've got a better grasp on things. And research shows that we don't really, but we feel more confident, which is really bad because then we make really bad decisions. But what happens, we want to get things entitled. I want to have a really simple explanation for exactly what happens or what I should do or how I should invest. But the problem is that nuances challenge all of that. And there's this concept called narrative therapy, in psychology, and that deals with this. And the idea is that basically what we do is we tend to think in terms of stories. When I say to you, I give you the image of a dollar bill. You think of a dollar bill. You think of what the value of what it purchases. You're thinking in terms of the story of what a dollar bill does. And if I give it to somebody, in some other part of the world, in a remote part of the world, it's toilet paper to them. The reality of it is it doesn't mean anything to them. It doesn't mean the same thing. And what happens throughout our lives is we will have things that happen to us, and then we will make up stories about it. Maybe somebody's father leaves when they're a little kid, and one person makes up that I wasn't worth sticking around for, or mom wasn't worth sticking around for, but somebody else may go, you know what, dad was a jerk. They may come up with a completely different story as to what really happened, what was really going on. And we think in terms of these stories, and something happens, we come up with a tidy little story to explain what happened. And we filter everything through that. So maybe if something happens when I'm a kid and, dad wasn't worth sticking around for, then, what I do is everything that happens to me, I'm not worth sticking around for. And then I end up with really super low self-esteem because I'm not worth sticking around for. So everything that happens in my life runs through that same filter. Now, in this whole trial, you might say, one side may be coming out with, racism is rampant. It's terrible. It's awful. It's unstoppable. It runs through everything. And then everything that they see proves their point. And the other side says, well, racism overblown. And everything proves their point. They look for evidence that proves their point. And we do the same thing with investing. I think the stock market's going to go down. So what I do is I look around for every piece of evidence that I can find that tells me that stocks are priced at too high of a price. And you know what I might run into? Matter of fact, I did this week. I was actually showing somebody this. I said, if you look at price earnings ratios of the S&P 500 right now, you can see numbers that exceed 25 to 1. But if you look around, you go, whoa, wait a minute. If I actually look at forward price earnings ratios, which is what I think earnings are going to be coming up in the future, the general consensus of informed investors, all of a sudden the S&P 500 does not look overpriced. Now, if one person was looking for backward-looking earnings and looking in the past, because you think about it, and it was even worse earlier in the year. Because we came out of COVID, we came out of a complete shutdown, we came out of a period of time where there was no activity going on, and earnings were super, super low. The denominator in my fraction was super, super low. Now, if I have a super, super low denominator, bottom number, then my ratio, top number to bottom number, looks skewed really, really high. It looks like it's super, super high. But what has been happening recently, so I'm telling you, this has gotten better, is that the denominator has grown. So our earnings have come up to make our overall fraction a smaller number. But if you still look at backward earnings, you look at the earnings over the last year, and you look at the fraction as a result of that, you will see a number that looks still to be super, super high. Now, it is the highest area of all markets as an investor, so I tell people, you got to really watch out, having all your eggs in that one basket. But you see what I mean, that you can go around and you can look for information. If I think that things are going to go really, really well in the future, I will particularly look for every piece of information, every article, every opinion, because there are tons of opinions out there, right? Everybody's telling you what they think the stock market's going to do. And I will look for everything that tells me that stocks are going to go up. So that gives me the right and the reason to go and invest a whole bunch of money because I think it's going to continue to go higher. So this is how people get trapped. They invest because emotionally they think it's going to take off, or they don't invest because they think it's going to go down in value. And this is the same thing that happens with, like trials, like we're talking about right here. We look for information that, because we just want to make it nice and tidy and neat. And my sister goes, well, I don't like being wrong. And she's, but I'll admit it with great difficulty. And I said, welcome to the club. And I says, the idea behind there are these postmodern forms of therapy is that truth is socially constructed. That it's all a social construct. What you think and what you believe is based on what society believes and the culture that you grow up in. That's where you get your beliefs. And you'll get people that really believe this, as if there is no objective truth out there whatsoever. Since there's no objective truth and everything is based on what I believe and what society tells me to believe or what society has taught me, then you really can get into an act of futility when you're trying to debate these people. If something's debatable, and then debating is an act of futility. But there are things that, pretty clearly spelled out. And, here's what happens. Right and wrong is dependent upon, what we as a society determine is right and wrong. That's their idea. And you don't have to spend too much time thinking where that's going to go wrong. Now, what does that have to do with the stock market? Well, this can have a huge problem when it comes to investing. Why? Because when you invest, it seems like there are limitless things that you can invest in. You can literally do just about anything. And, you'll hear people say, you need to invest in real estate right now. Oh, no. You need to be investing in dividend-paying stocks. Oh, no, you need to be investing in growth companies right now because COVID is about to kick back up and we're going to close back down and technology companies are going to do really, really well right now. And you're sitting there going, Calgon, take me away. I don't know what to do. This is so, and that is why we diversify. Because the reality of it is the opinions are everywhere. You can't truly know what the best investment is right now. Why? Because what the best investment is and what it's going to be is driven by news. And news is something we can't know before it happens. So as an investor, you don't know what the best thing is going to be until after the news comes out that actually drives markets. Because markets are not responding to what's going on right now. They're responding to what is likely to happen 2 to 3 years from now. And there is no objective truth as to what is going to be the best thing because the reality of it is people all do have different opinions on that. And what happens is so nuanced that even though we want to put it in a tidy little box, even though we want to make it so simple and just all I have to do is this and it'll be all done, you can't do that. This is why we diversify. And, you look at this and go, oh, wow, this is really makes it much more hard. All I can use is evidence-based practices when I'm putting together an investment portfolio. Logic tells me that small companies should have a higher long-term return than large companies because there's more risk. However, you can have somebody come in and say, and confuse you and say, well, look, wait a minute. Look, no, during this period of time, small companies were outperformed by large companies. And they would be telling the truth because 17% of 20-year periods, large companies did beat small companies. So you can see how you can get fooled when it comes to investing. And then you could have somebody says, well, value company. Oh, no. Look at this period of time. Value, and this has recently just happened, value was outperformed by growth. Now that will happen in 4% of 20-year periods. Just happened in the last 5 to 6 years. Not a 20-year period yet, but it's pretty doggone close for the past 20 years because of the skewing during Trump's presidency. Hasn't been happening since, and that's been reversing, but somebody could use that to actually fool you. I see people do that with annuity. They'll do these illustrations. Oh, look at how our annuity did versus the S&P 500. And you don't realize that what they're doing is they're choosing a very specific time period where their product worked better because emotionally they're trying to get at that part of your being which makes decisions based on emotions. And this is where it is so hard for us to be really objective because emotions, we tend to buy on emotion. And then what we do is then we justify by logic. And so often logic loses. And here's the deal, is if I'm afraid, I am going to look for every piece of evidence that backs up my decision to put all my money in cash. And it's really hard to talk somebody out of that. And this is why I am such an advocate for education. Not everybody is going to become an educated investor. I'm going to tell you, not everybody's going to put forth that effort. Not everybody's going to put forth the effort to become educated on anything going on in political circles either. And the reality of it is, when you recognize, and as I have with the investing world, I've recognized that I'm not going to save everybody. And I think, waxing philosophical, this is something, everything that has gone on this week is really hard simply because there are people that we care about that we disagree with. But I guess if we get to the point when we realize that there are some people, you're not going to reach. And I'm not going to reach when it comes to investing, not going to reach when it comes to things that you feel passionate about, no matter what the topic is. And when we start to realize that, then we recognize, okay, maybe there is some rational reason for the discord that's going on. And, patience and time. I think it's probably the only thing. As time goes on, people will start to come to the truth when it comes down to it. Investing 20 years ago, I never thought in my wildest imagination that people would recognize that stock picking and market timing were a big waste of time. And now they're starting to come to that conclusion. There are a lot of things, but this is why I patiently spend so much time educating on these things. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. You want to learn more about what we do, go to our website, paulwinkler.com. You can watch some of the videos there, and if you're not already a client, you can set up a free initial consultation. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one.